All right, welcome everybody to today's Option Hour. Join us every Tuesday for the Option Hour. My name is Don Kaufman, the host of the Option Hour, and I'll be taking your questions here live on the air today through, of course, Tiger Financial Network. Anyway, again, thanks for joining us here today. Kind of a coming into a holiday week. We got a little bit of lower volume, a little bit of slower trade, a lot of chop going on here, but we'll discuss that here in just a couple of minutes. As you guys know, this is the Option Hour. It is a call-in show, so give us a call with any of your options-related questions. In that regard, if you want to give us a call, talk about futures, options on futures, any individual stocks you've got some questions on, we are happy to talk about those, answer a few questions. But you guys, if you just want to call up and say, hey, you know, I'm thinking of doing a trade here on the spiders, for example, whether you're bullish, whether you're bearish, whether you're neutral, maybe we can give you guys some insight to those particular trades. But as usual, give us a call, 877-927-6648. Lines are wide open here for you guys to give me a call and fire away some questions, or even if you've got comments, that too. And as usual, I've been doing this the last couple of weeks on the show. If you want to give us a call and talk about the most horrific trade you've ever had, it's interesting to listen to. So for our amusement during the Options Hour, horrifying trades that you've had in the past, give us a call. Ooh, even better yet, maybe you're in the middle of a horrifying trade right now and you need somebody to talk to about it. Anyway, we'd love to exploit you live here on the TFNN network. Anyway, with that, let's give you guys kind of a quick recap of the marketplace and get things rolling with a couple of callers here. By the way, I'm also reading the Tiger Den. And I've been going back and forth to G7 here a couple of times in there, talking about Tom Sosnoff, which is quite amusing. Anyway, markets as a whole. E-mini S&P 500 futures, 1289.50. They're up 13 and a quarter on the day. We are literally at the highs of the day right now. NASDAQ futures up 27 and a half. NASDAQ has been really the stronger of the index products here in the last few trading days here. In fact, yesterday the NASDAQ was literally on fire throughout the day. Dow futures up 112. Of course, spiders in line with the E-mini S&P 500 futures. Spiders up $1.40. All right, VIX down about $1 today. You know, the VIX was actually hovering at that 20 level. Thought that was pretty interesting, even after yesterday, a few days of a rally here, and the VIX still up in that 20 handle, which is not bad for those of you that do sell option premium. We're still paying out at a 20 VIX. Hey, it beats what it was a few weeks ago at 16. I mean, it was amazing. A couple of weeks ago, we're selling off fairly hard, and the VIX is sitting and stagnating at between 16 and 17. So that was not too exciting. This is much more exciting. Anyway, with that, not a huge move today. The euro is at, of course, the euro-U.S. dollar is 143.602. Bonds is not a huge story, but TBT is definitely off of its lows here. So those of you that do watch bonds, it's been a little bit of sell-off in bonds, and maybe I'll even pull up a chart throughout the day. That is a rare occurrence for me. But bonds, and I'll look at TLT. Obviously, it's the equity product, which is the equivalent of the kind of a 20-year bond here, is definitely off of its recent highs. It was touching right about 98, sold off a little bit. And for those of you that are short bonds, which means you're long interest rates, that's been a pretty good trade for you. Also, oil popping off of its lows. Anyway, with that, again, this call-in show, we'd love for you guys to call us. And by the way, G7 rooting for TBT. I am right there with you, my friend. That thing cracked into the 32 level. We're talking about TBT right now. It cracked into the 32 level the other day, and I really thought I was going to wet myself because I'd be long, and I'd be really, really long. Anyway, with that, I'm going to go to the first caller here, and you guys can, of course, give us a call. It's 877-927-6648. First caller is Brian in, looks like, Massachusetts. Got a question about SDS. You there, Brian?
Thanks for taking my call.
Yeah, no problem.
I know I listen to Tom every day and Larry. I know the market might correct when it gets above, 1,300 or whatever.
Yeah.
Is there a better way than just buy, say, a September, 22 or 23 call on the SDS?
So you know what? I'm not a huge fan of trading the options here on the on some of the double inverses and so forth. And simply the reason is, first of all, what is the SDS? So it's an inverse product of the spiders, but the spreads, although they're fairly tight in here, if you pull up like volume and open interest, I'm looking for instance in August right now, and you look just a few strikes out of the money. The open interest is like 1,800 contracts, not massive. The bottom line is you might as well just utilize the spiders and just, and really kind of formulate the trade over there. And it's really, options are already your leverage. You don't need more leverage by trading the SDS unless you're going to trade the physical underlying stock in that. But the bottom line is, you believe a sell-off is coming here, or are you just trying to protect the portfolio?
A little of both.
Okay. So, one thing I always talk about, and I'll jump back to the spiders here for a moment and kind of bring up a couple of ideas for you. So I'm looking at the August options, 52 days left till expiration. By the way, you'll see the open interest here in the August options, instead of being 800 or 1,800 like it is over in SDS, and it's like 57,000. The open interest is just amazing in these options here. Two different ways you can go about creating some protection here. If you believe there's going to be a correction, number one, I'd look at probably like selling an out-of-the-money call spread. It's defined risk, pretty straightforward. When I say, defined risk, you're selling a spread, for instance, selling the 132s, buying the 134s. The only downside of that is you're only going to collect about 70 cents or so for selling that particular call spread, so it's limiting, obviously, your profitability. The other thing that you might want to consider looking at is buying out-of-the-money put calendars.
Okay.
You're pretty familiar with those or no?
I am.
All right. I got to be forthright. I don't like the idea of just buying a put or buying, you mentioned buying a call in the SDS, which is the same thing as buying a put over in the spiders. I mean, if you look, for example, at like, I'm looking at the 126 puts in the spiders, and I'll pull up, like, for instance, probability of expiring, and I'll pull up the other information layout to be delta. There's about 38% chance that we fall in the money on the 126 puts. But the puts right now are trading for like $1.25. You're going to need us, for a break-even point, worst case scenario, you're going to need us all the way into the 123 level.
Exactly.
Yeah, to get all the way down to like 123, got about a 28% probability of that happening. The thing is, right now, if you look at buying puts in a major index product, and a lot of people don't look at this kind of stuff, but if you look at buying puts, that's one thing. But when you start to look, forget about probability of expiring, forget about delta for a second. You look over at what is called implied volatility. There's a decent-sized skew in these puts right now. So, the at-the-money options you're paying like, 16, 17% for. When you start to get to the out-of-the-money puts, they get really expensive. And that's because so many people are buying puts to be able to hedge downside protection. And these prices they're expensive right now. There's no question about it. So with these puts jacked up, they're bid up a little bit in terms of price, probabilities are really not on your side. That being said, buying a put does provide you decent protection. But I like the idea of having time on your side. You could sell a call spread and then go out and buy a handful of put calendars like August, September, or even August, October out there. Might work out for you.
I appreciate it. Great information.
All right. Thank you for giving us a call, Brian. All right. So with that, we're going to jump to another caller here in just 1 second. But if you're thinking about giving us a call, you should. I'm still reading some of the comments over here in the Tiger Den. Feel free to chat in over there for anything. It's pretty amusing listening to some of you guys. So anyway, give us a call, 877-927-6648. We will discuss your option position, your portfolio, whatever you got live. Anyway, with that, I'm going to jump to another caller. We got Alan in Seattle. He's got a question about portfolio management. You there, Alan?
Yeah, I am. Thanks for taking my call.
How's it going?
Good, thanks. So I'm relatively new to options. I've been trading for maybe 2 or 3 years, trying to learn as much as possible.
Sure.
I'm a big fan of selling premium, and right now I'm trying to focus on about 4 products, the Diamonds, IWM, Qs, and Spiders. And I try and diversify the options that I'm selling, 1 to 2 and maybe 3 months at a time, so no more than 3 months out. and I put on a few positions, spread over a couple of weeks. I watch them, the market moves, and I'm looking for some tips and tricks on how to best manage, a portfolio like that, especially when the market might be running up to one of my break-even points.
Sure. So when you're looking at a break-even point right now, you're looking at a break-even point, for instance, of your July inventory, and I'll just use the spiders. I mean, whether we talk about the spiders, the Qs, the diamonds, the IWM, for the most part, they're moving in relative tandem. The NASDAQ right now is outperforming spiders by a nominal amount. Those switch up over time, so they track one another fairly efficiently. But if you look, for instance, at like July options, and you start to hit a break-even point, the first thing is, there's no easy fix anymore for July options. There's only 17 days left. One of the things that a lot of people have a difficult time with is when you first start, trading options, and specifically, option portfolio, which I'm about to get into. But when people first started trading options, they're usually very, autonomous in that they put on a trade in July and take it off in July. They put on a trade for August, take it off in August. One of the first steps towards really managing the portfolio more efficiently is going out and starting to create that inventory in July and August and September, just like you were mentioning a moment ago. And that's, right now, obviously, you're done allocating to July, you're allocating to August. You're probably already looking at some calendar spreads for like August, September, or even August, October. So you start to achieve in portfolio management what I call diversification via capital allocation. And that is start to break your capital into, for instance, 3 to 4 parts. And when I say 3 to 4 parts, you're allocating, a certain percentage just to July options, front month options, allocating now to August, and of course, continuously allocating to things like calendar spreads, which are of course going to be July, August, July, September, August, September, August, October, and really start to build out an inventory. Now, where you're at is you're already starting to hit your break-even points in July expiration. So I'm taking it this little run-up has probably you started taking some heat like around the 130 strike or 131 strikes. Is that about right?
Yep.
All right,
yeah, that's exactly right.
So for the most part, your portfolio, if you're starting to hit the break-even points on the upside, your portfolio is actually becoming what's called negative delta. Now, there's a couple ways to deal with negative delta, and that is to add a little bit of positive delta. The easiest way to basically say that is, you could go out and you could sell a handful of put spreads, so out-of-the-money put spreads, to help alleviate some of the pressure that you're taking to the upside. The other thing is that you've got to realize that anything that you add to your portfolio to help manage the risk. Okay, so I'm not an advocate of fixing like one of the trades that you have on. So you've got some risk at the 131 strike. Well, I'm not going to try to go out and try to fight that 131 strike just for that one trade. Hopefully you've got multiple trades layered and that there's not a monstrous amount of risk right on 131. But regardless, the one thing you've got to realize is anytime you try to manage the risk of that particular portfolio, you have to stay in the logic of the portfolio. And that simply means if you're positive theta, and you mentioned selling premium, you want to keep your trades positive theta, meaning you want to keep selling out-of-the-money junk, or you want to be buying, calendar spreads or something to keep, obviously, time decay in your favor. A lot of mistakes that are made is whenever I say, hey, you need to add some positive delta to your account, literally people go out and might buy a call to try to mitigate the risk of the options that you're short, right? And, I totally understand. That's kind of like a panic response to it. But you just want to keep that logic of the portfolio down. So selling a put spread would work. Another thing that you could do is you could buy, for instance, a slightly in-the-money call spread to help reduce some of that risk. And by that I simply mean, and this is where things start to get a little esoteric, is when you've only got 17 days left, sometimes it doesn't pay to sell a put spread, meaning you'd have to sell like a right-at-the-money put spread. And what's going to happen to you is you're trying to reduce some of the risk of the short calls that you've got on right now. So you're short, for instance, 131s, 132s, 133s. You're long a couple other calls out here. Markets are rallying. You're taking heat to the upside. You go out, you sell a put spread, and before you know it, market sells right back off and rips right through the put spread. And because we're so close to this expiration cycle, the put spread, you didn't even collect that much money on it. So, you got a put spread that you collected, 60, 70 cents on. You just got smoked for an extra $1.30, which also brings up another point. Make sure whatever you're doing to help reduce risk is the same or smaller contract size than the positions you normally trade. So if you, for instance, normally trade, 5 contracts, don't go out here and try to sell a 50-lot put spread to reduce the risk of 5 contracts. That, and the reason ultimately is this: you never want the hedge to become the source of the risk. All right. So when you start coming really close to expiration, what you can do is start to manipulate things by going out, for instance, like buying a vertical. I can add the money vertical here. Here's a several-point vertical, and if you take a look at the one that I pulled up, for instance, I pulled up a 128, 131. It's for about $1.70 debit. This spread is already in the money here. All right, quite considerably, and it's got very little extrinsic premium, and that's part of what you want to do is pay very, very little for time value if you were going to buy one of these spreads. This is not, by the way, a great example. I could pull up like a 127 here. This is a little bit of an example. 127, 132, for instance, you could buy that particular spread for $282. It's still not a great example. I'm looking for one that obviously has very little extrinsic premium associated with it to just help you get a little bit of positive delta in that portfolio. So are you kind of with me, or did I just fire a little bit over your head?
No, that makes sense. One thing I'm wondering about is if I keep selling options, is that going to give me more gamma risk then?
Well, gamma risk really only comes into play the last approximately 10 days of an expiration cycle. Gamma risk starts to come in. And what gamma risk really is, gamma risk, can't be looked at. By the way, the gamma risk that we're talking about, by the way, is negative gamma. Anytime you've got a portfolio that produces positive theta, positive time decay, you generate negative gamma. And again, people look at the negative gamma. Can it be a really bad risk? Absolutely. But for the most part, when you look at it, you're like, oh, man, my gamma is getting really big. But that also means your theta is also getting very large. So obviously, they're directly linked, and both of them are growing exponentially the closer you come into expiration. The problem really comes with negative gamma in like the last 4 days of the expiration cycle. So if you've ever, heard me speak before, do some of these classes, I always say, whenever you sell options a month, 6 weeks out, you kind of want to exit them about 4 to 10 calendar days prior to expiration. That's to avoid the extreme negative gamma risk that's associated, with that last 3 or 4 days of an expiration cycle. I mean, for the most part, you have an option position on, and it's multiple option positions. You've created this portfolio of options. You've done everything you can all month long to try to control that risk. And ultimately, in the last 3 or 4 days, you just turn it all back over, because when you've got a big negative gamma, it just whips your delta around. Just basically what it means is your directional control is gone. You're along for the ride in that last 3 or 4 days, which is never a good thing.
Right.
For the most part, you're not necessarily in a bad position. The other thing you have to start to think about is when you've got like 17 days left with a position like you've got on, you can take some directional bias in here. So we've had a little bit of a rally back, but we've got kind of a chop trade going on right now. You got to ask yourself, do you think we're going to continue to rally up? And, if the answer is yes, and, are we really going to rally up for the next 17 days? We're going to sell back off. So whatever you do, if you do something against your portfolio right now, do it really small. I can't tell you how many times I've gone out and hedged a position and only had the market whip right back around. That being said, there's one final thing that I'll talk to you about on here. I have in my head at all times definitive levels of the amount of directional risk I'm willing to incur, meaning, I beta weight my portfolio, for example, to the spiders, and I know in my head, I'll give you an example, that I will not take more than, for instance, 2,000 deltas of risk in either direction. That's plus or minus. So if we ever approach that number of 2,000 deltas, and what that really means is if the spiders move up or down $1, okay, for every dollar they move up or down, I'm going to make or lose $2,000. And I'm okay with that, but you got to start to realize, all right, so in a really big day, the spiders could move $4 or $5. In a catastrophic day, they could move as much as $8 to $10. And although it's not linear, you got to ask yourself, are you willing to ensue that amount of risk? So, for instance, 2,000 deltas is, that's threshold for pain for me, and I don't get anywhere near it and don't exceed it. So when we start approaching, 1,700 deltas, I'm going to be eyeballing it big time. We start hitting, 1,900 deltas, I'm actually going to go out and start chopping down the risk. But I don't try to mitigate all the risk at one time, meaning like I can see the risk coming. It's like, all right, if we rally up today, I'm getting a little bit screwed, but if we rally up tomorrow, then I'm really going to be getting hammered more. So I'm constantly putting these small little chunk positions on to help chop down some of that directional risk. And that's more about position management and portfolio management than it is, most of the people that listen to a show like this they're traders. They're trying to scalp in and out of markets. They're all directionally biased, and that works to some degree. But all of a sudden, if you want to start, really allocating, serious amounts of capital, and I say serious amounts of capital, if you want to build an option portfolio, you've got over, $100,000 in your account, it gets a little more serious. I mean, you're not going to go out and just throw everything into Apple or not throw out everything into RIM right now and bet it all on the line there. And that's really where position and portfolio management kind of come into play.
Right. When would you start using E-minis to hedge off some of your delta risk as opposed to just adding more spreads?
For years I've always said I have a really definitive number for that. Unless you're willing to accept about 1,500 deltas in the spiders. So 1,500 deltas is usually what I tell people because, I see positions like this all the time. I'll see like a client, they've got 700 deltas right now in their portfolio. So, and that's equivalent to spider. So this client is, positive 700 spider deltas. They're freaking out. They're like, oh, no, I'm getting killed here. I'm long 700 spider deltas. So they go out and they sell one E-mini S&P 500 future. Well, one E-mini future is equivalent to short 500 spider deltas. So all of a sudden they take this portfolio from long 700 deltas now to only long 200 deltas. Before you know it, what does the market do? Well, the market turns back around the opposite way, and now they're sitting, instead of being positive 200 deltas, now all of a sudden they're negative 300 deltas. And literally, they'll end up losing more on the futures product than they would have possibly even been able to generate on the option decay itself. So I find that the good cutoff number is when you're willing to start taking over 1,000, and really the hard line number I always give people is about 1,500 spider deltas. When you're willing to kind of ensue that amount of risk, you're ready to start scalping futures against the portfolio. And I always use that term scalping futures because, basically what I do is, I put a future on, take it off, put it on, take it off, several times, sometimes within a day if I'm sitting at home. But I'll also use it to manage my risk. Like, right now, I've got a position on right now, and I'm short, some futures, but I'm also like long TBT, and they're really hedging. That trade kind of hedges one another. To kind of understand that I'm short, for instance, the S&P 500, but I'm also short bonds. Well, if the market rallies up, for instance, like it is today, you typically see a sell-off in bonds. Okay, the sell-off in bonds is actually a good thing for me. I'm short bonds, but I'm also short S&P. Now, if the market were to sell off hard, I've got a hedge here in bonds. I've got the hedge here in the S&P. So if the market sells off hard, I'm making a little bit of money in the S&Ps, but I'm usually getting hammered a little bit in my bond position because obviously as markets sell off, bonds rally. So yeah. I mean that's a type of it. And that's a little bit of a parish trade. And I don't do it necessarily just by selling futures. I'll literally go out. Like I've got a position on right now where I am short TLT call spreads. I'm short out-of-the-money TBT put spreads. And then I've got futures on against that particular position. And I'm just making a big convoluted mess for you right now, probably in your head. But feel free to follow up on that one because this is kind of stuff that I think a lot of people that listen on like a day-to-day basis to some of these shows, they don't really get that side of the business. And when I say they don't get that side of the business, I mean I am in essence trading a little bit directionally, but I don't just purely say I think this stock is going up. I find that a really hard business to make money in.
Yeah.
I don't like the idea of going out there and saying long and short. And, I've got a couple things that I'm going to talk about being long or short for some little positions here and there. But ultimately, I mean, the bottom line for me is if I am long a stock, I'm going to sell a hell of a lot of premium just to make it worth being long. So everything I'm going to do, I'm going to sell some type of option against it because, over the years, I look back at some of my stock positions, and these stocks, they don't really go anywhere. I mean, I've had TBT for a long time. I mean, literally, I own the physical underlying now, and when I look at this position, I mean, this first of all, owning something like a double inverse is not really smart because it's got a decay rate associated with it. This is an underlying, though, that's gone from, the 30s up to the mid-40s, all the way back down to 32 and back again. And, when I look at the underlying, I don't usually make any money in the underlying, but I've sold tons of premium against this thing over the time I've actually owned it. And I look at it, back at a lot of the stocks I own, and it's similar.
When you sell premium, how far out of the money do you typically go, or just one or two strikes, or?
Yeah, so normally I'm right between like a 30 and 40 delta on the premium I'm selling. But I'll tell you what, I'm going to pop over. I've got like a little mock portfolio I've made up over here, and sorry, there's a couple people trading in this account, but I'm looking for some of the messes that I've made. For example, you'll look at a position that I'll have on, like, I don't have anything good in this account. I'll open one up here really quick, and then I'll talk about this underlying. You look at something like Starbucks, for example. This is just a stock I have in this particular portfolio. And I'll go out, and I don't just sell, like, one strike call, meaning, like, I don't go out and say this is the 35 delta option. I own 1,000 shares, and I sell 10 contracts. I have tendency to break those trades up a little bit. So if you're to look at Starbucks right now and you were to open up, like, the August options, I'll go out, for example, and I'll sell, a handful of the 40 calls. Then I'll sell a handful of 41s and a handful of 42s. I just feel better about it because when I sell by X number of those 40 calls, for the most part, I feel like I've capped my upside. I'm just, never thrilled with it. So I actually stagger those trades, break up the strikes, and it's especially easy when you've got dollar strike increments there in the options today.
Yeah, definitely.
Yeah, I mean, it's, hopefully you have a commission structure, hopefully that allows you to do that. So I'm a big, advocate of a per share kind of fee on commissions, only because I think it really helps, clientele in getting in positions, getting out of positions. One thing that drives me nuts, everybody has a tendency to look at this world in all or none. I have 10 contracts on. It's either on or it's off. Why not take off a third of it? Why not just take off half of it? You've got a position right now that's going against you. If you really are taking heat, you can't handle it, take a little bit off. Take a little bit off, see how things go. Usually when I exit like half my position, that's when things turn around and go my direction. I mean, it's just, it's the Murphy's Law there. And that happens to everybody, though. It's when you can't take the pressure anymore and you close the position, that's when the market turns around. I mean, that's how markets really function.
Yeah, I mean, I can't pick direction to save my life, and every time I make a trade, the market does completely the opposite. So I should probably start doing the opposite of what I think.
Yeah, it's funny you mention that. So over the years, I've always found, like, there are times my directional bias is absolutely spot on. I'm as hot as can be, in all seriousness. And the other half the time, I'm so cold I couldn't find the front door of my own house. I mean, that's it. Traders run really hot and really cold. The biggest problem I have is even when I have a good directional bias, it's not usually the way I trade. Like, I will, by the way, there are times in my career that I've taken monstrous directional positions, no question about it. In 08, 09, I was, monstrously directional throughout that period. But I find even when I have a good directional bias, typically I'm not really trading on that all that much. Or I'm trading like, small positions there because, I don't know, I just don't trust my directional bias. And once I get caught up in that, I have tendency to neglect my entire, option portfolio, which is everybody does that too. I'll go out there and sometimes I'm, trading futures or trading, God knows what intraday. And I'll be trading something intraday and forget about the fact that I've got, a $180,000 option position that I just let blow up in my face that particular day because I was worried chasing, 2 contracts of an E-mini future. So, listen, everybody makes the exact same mistakes in this business. You just got to try to learn to cope with them and make a little bit, less mistakes as you move on.
Right. Makes sense. Do you find yourself able to keep fairly consistent returns month over month, or do you find yourself, kind of oscillating a fair bit?
I've definitely got oscillation going on here. No doubt, the last probably 18 months, I'll tell you exactly how my trading has gone the last 18 months. It's pretty much been flat, 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 flat. Make a little bit of money one month, flat, flat. I mean, like every month, I'm like grinding out premium. And, I've been short a lot lately, and it's been tough until, the last couple of weeks. So I felt like this, for instance, this entire trading year, obviously starting in January, it was grinded out for 4.5 months, had 3 or 4 good weeks, which is, by the way, that's fine. Percentage-wise, it worked out for me. That's the way my trading has kind of gone the last, 18 months. And it's primarily because the VIX has been a little bit lower. So it's been a challenge to get allocated enough. When the VIX is under 18, I'm typically grossly underallocated with my portfolio. When the VIX starts to get above 25 or in the 30 range, I'm usually fully allocated. And it's been a long time since I've been able to get that whole entire allocation on. And that's typically the way, things roll. Again, I'm underallocated in a low VIX situation, and I'm usually firing pretty good when things get exciting. The last time I fired pretty good was, what was going on in Japan. There was a lot of trade wrapped around that. Right now, this is something I'm going to talk about later in this show here, but might as well cover it right now. A week like this week and next week, I'm very careful here. Over the years, I've really bit the bullet hard surrounding July 4th, and it's because we get these low-volume, choppy trade days. When you get low volume like this, people are like, oh, there's nothing going on. Nothing can happen. Low volume, though, opens the door to possible erratic movements. Okay, and with a lot of program trading going on and a lot of algorithms kicking in, these trades can actually get a little bit dangerous here. So keep your eyes open for that. This chop trade can actually, again, get a little bit dangerous as we get closer and closer to surrounding a holiday. And I found over, right around the July 4th, there is a considerable chop. Not a lot of big traders working hard right now, in the dead of summer. So, keep your eyes open for that. And who knows about this rally, man? I'm torn on this one. I like the fact that TBT is finally rallying back up, but, I don't know if I'm buying into the fact the markets are rallying here.
Yeah. I've got one other follow-up kind of on the portfolio management, if we still got time.
Sure, fire away. One more.
When you said you're fully allocated, when the VIX is higher and, not as allocated when it's lower, what do you define as fully allocated?
Well, if I actually look at, I break up capital into segments for allocation. For instance, if you have I'll just say a $30,000, allotment that you want to put specifically to options, futures, and by the way, stocks, options, futures, all trade seamlessly today. Let's say you got a $30,000 allocation. Just break it into 3 parts. You've got, $10,000 to break into several different expiration cycles. It's really that easy. Now, it's how much of that allocation are you really utilizing. So what you have to be careful of is that, as you're moving forward, if the markets are not really moving, meaning the volatility is not high, there's not a lot of risk in play, it's harder to allocate money. When we're grinding to the upside like we have been from the beginning of the year, obviously, pre this big sell-off that we had the last couple of weeks, but as we're grinding to the upside of the marketplace, it becomes more difficult to allocate capital as we're stagnating at specific strikes. So if you looked at the spiders here, it's kind of hard to allocate a bunch of capital month after month when we're just grinding to the upside. And, these charts are just, it's amazing, some of this up move. But the up move has got lower volatility, and you start overlapping more and more strikes. And, again, it becomes a little bit dangerous. So you're typically grossly underallocated as we're rallying to the upside. Now, as we sell off, we typically sell off in a more extreme fashion. As we do that, it gives you more opportunity to allocate, and it gives you a higher volatility. So you can get off things like more iron condors, more vertical spreads. Hopefully when we're selling off, you already have out-of-the-money put calendars to help manage some of that risk. But that's really what it's a function of, is movement of the market versus volatility.
All right. Makes sense. Hey, thanks a lot for the answers. This was great.
No problem, no problem. Thanks for giving us a call there, Alan. So we'll kind of move on, talk a little bit about the markets as a whole here, and if you guys want to call, give us a call today. You know, we spent some time there in portfolio management, got a little out there in the Greeks, but it's a good thing. You know, for those of you listening, I have absolutely no idea what I talked about in the last 20 or 30 minutes or so. It's, you know what, it's something to reach for. You got to realize that this business, this is as deep as the rabbit hole gets. You know, we start talking about delta, gamma, and we're talking a little bit about negative gamma risk and positive theta. It's okay if you don't latch on to all those terms right now, but at any time, if you guys want to know a little bit more about that, we've got tons of different chats that we do on Thinkorswim on a day-to-day basis. And, wow, that was a really good commercial I just put in there, right? Tons of chats on Thinkorswim. Just go to support chat on the Thinkorswim platform. The other thing you can, of course, do is check out, you know, some of our websites and some of the archives that we have available. There's a question in here that I want to kind of address, and then we'll kind of move forward from there. But, by the way, give us a call. We've got plenty of time, 877-927-6648. All right, in here, the Tiger Den, we've got a quick question. It says, Don, you said the VIX is not used by you to measure volatility. What do you use to look at volatility during your trade? So, first of all, I want to say this. The VIX, okay, is still utilized to measure volatility, and we still do utilize it. It's just not as effective as it used to be. And, again, this is a question over in the Tiger Den that popped in here. So we're not looking at the VIX, all right, like we used to. When products become tradable products, and I'm going to say this, the VIX used to just be an indicator. I mean, for the most part, the VIX was like any other indicator you would utilize. The VIX is the S&P 500 Volatility Index, but now the VIX is a tradable product. It changed the nature of this product when they started trading it. And for the most part, it's become much more efficient, and it's a different animal today, so you can use it. And on a day-to-day basis, I do look at it. So, you know, on a day-to-day basis, I'll say, okay, the VIX is down 90. That means this is a fairly decent rally. All right, so the VIX is a measure of the S&P 500 options. If everybody in the world right now were trying to buy options, the VIX would actually be up considerably. Right now, there's not a lot of buying pressure on options. Therefore, the VIX is down. So more options are being offered for sale than being bid on, and that actually controls a little bit of the VIX on a day-to-day basis. So on an intraday basis, it's interesting to look at the VIX. When you're looking at the VIX, though, on a longer-term scale and trying to compare it to what the VIX was 5 or 10 years ago, you really can't. All right, the VIX, again, is kind of a different animal. The other thing you have to start to realize is that there are other products now that traders are managing the risk within, and that simply means this. When you go out and you're a trader, okay, you can manage your risk in several ways. You can buy puts. And a lot of people buy puts to be able to manage risk, right? But today, it got easier, meaning like I don't have to go into the S&P 500, go into the spiders and go, oh, no, the world is coming down, and click on and buy a put, because the more puts I buy, the volatility gets bid up. That's what the VIX really does. So if I start buying puts as insurance against my portfolio, it is literally bidding up the price of those puts. Well, rather than do that, a trader can go out and they can sell futures. They can just click here and they go, oh, forget about buying puts. Let's just sell futures, because selling futures protects them to the downside. Or better yet, they'll turn around and they'll buy bonds. So they'll literally buy bonds. So you'll notice on a big down day, people go out and buy bonds. So there's a variety of ways to be able to manage risk today outside of that VIX. And again, talk about the VIX. I look at the VIX, but I still don't believe it's the same animal. Markets evolve, constantly evolve, and become very efficient very rapidly. So the more people that look at a particular product, that product, you know, we believe becomes less and less efficient over time. All right. So, by the way, somebody says, what do you do if you don't want to use a future? By the way, you never have to use futures. So futures products, personally, I love the futures. But the problem is with the futures, they're big. They're really big, meaning like the size of this contract is equivalent. An E-mini S&P 500 future is the same thing as trading 500 shares of the spiders. You know, if you don't like the idea of trading futures, all right, so utilize the spiders. But the problem with the spiders, they tie up a hell of a lot of capital. One of the greatest things about futures, I don't know if you guys realize this, whether you buy or sell a future, they only tie up $5,000 overnight. And they're really inexpensive in terms of transaction cost over there. So you can literally buy one E-mini S&P 500 future. It's equivalent to 500 shares of the Spiders. You know, on Thinkorswim, it only costs you $3.50 commission, whereas if you went out and bought the Spiders and you bought 500 shares of the Spiders, they charge you, $10 for transaction costs. And think about this. If you buy 500 shares of the Spiders, what is that going to tie up in terms of capital? So we'll pop open here 500 shares of the Spiders, and you'll see 500 shares of the Spiders is going to tie up $31,000 in capital overnight. So it's how you utilize margin. One last thing about futures to kind of, I'm turning into a promotion for futures right now. One interesting thing about the futures markets, futures trade just like stock. You can buy them, you can sell them. Options, you can buy them, you can sell them. Futures, you can buy them or sell them. But the reality is futures have one interesting property associated with them. Well, several, but there's one really interesting one that a lot of people don't know about, and that is futures are regulated by the NFA and the CFTC. That's the National Futures Association, all right, and the CFTC. They're not, looked at by FINRA and the SEC. So what's different about that? The margin is different, yes, but it's also the day trading, margin rule. So typically in an account within the United States, you have to have $25,000 a minimum to trade in and out of a particular product, but that's an equity or option product. If you want to day trade futures, this is amazing to me because futures have even more leverage than does stock and or options, but the futures, they'll allow you to day trade those things, and you don't have to have $25,000 in your account. So that's kind of a double-edged sword for you there. If you want to go blow yourself up with a futures product, absolutely. The best comment I ever heard about futures is, first of all, a friend of mine, Frank Walsh, he writes a newsletter on mytrade.com, but Frank Walsh always calls futures chocolate-covered hand grenades. I love that comment. So if you want to trade yourself a chocolate-covered hand grenade, it would be great. But futures also, futures are, that's what this business is about right now. The business is spreading towards better utilization of your capital. So the more knowledgeable you are in this industry, all right, the more leverage you can actually understand how to utilize more effectively in your favor because it ties up less capital. So, wow, I went off on a huge rant there about futures, but thank you, G7, for kind of asking that question. Somebody's also chatting in here, and again, you guys can chat in. Feel free to talk to me, whatever it may be. What indicators do you use for volatility? Seriously, for indicators for volatility, on a day-to-day basis, yeah, sure, we look at the VIX there, but that's really it. I'm not tracking volatility all that much, but on the products that I trade, instead of using indicators, I look over here on Thinkorswim on the far right-hand side of the trade tab. I look at the implied volatility every single day of the handful of underlyings that I trade, and I do track that in my head. And if you don't understand the implied volatility over here, that's an important one. But you can also go back into the past with what's called Think Back, and you can go back days or years, and you can even look in Think Back at what volatility was, for example, several years ago. So let's go to one of my favorite times, September of 2008, and you'll see that volatility was starting to explode in the Spiders. And then September 18th of 2008, volatility was up over 30%. You kind of fast forward like a month over here. I remember October 10th was a fun day. October 10th, the volatility in the Spiders with 7 days to go to expiration cracked over 100% in the front month. So in some insane stuff there. So I'm not really using indicators. More or less, I'm just tracking it over time. And by the way, there's a feature in the Thinkorswim charts also that it's a study, and you can add a study under volatility studies, and it's IMP volatility, and that's implied volatility. And you can take a look at the implied volatility over time, and you'll see a big spike in implied volatility back in kind of mid-March over here. And of course, that was the Japan earthquake and the tsunami that actually followed. So yeah, take a look back if that works for you, but not really using an indicator per se, just taking a look back through time. All right. Anyway, let's kind of jump forward over here. By the way, somebody was mentioning they have the SEP 35 calls on TBT. So TBT, I typically don't buy calls in there. I'm usually selling premium, but the premium is not very good right now. I personally do not mind owning more TBT. So instead of using a put spread, I have tendency just to sell the puts. I'm actually in short 33 puts, short 32 puts, short 31 puts. And by the way, whenever I tell you guys about my trade, this is not a recommendation for you to follow along here. I'm even telling you this is not even that good of an instrument to trade because the TBT has a decay rate associated with it. But if you want to get long stock, and I'm comfortable getting long TBT, I mean, I literally want to own the underlying here, sell some options. And typically I don't talk about, being long something like a double inverse because it doesn't make a lot of sense unless you're comfortable holding a position that's going to decay over time. So keep that in mind. I like selling premium better than buying it any day of the week. If I had to buy something here in TBT, I would probably buy a slightly in-the-money spread. And if you look over here, I'm going to create one on my screen show. I don't know if you guys are watching the screen show, but like the 132, let me look here. Sorry. I'm going to look at the 33.35 spread and see what that thing's going for, 99 cents. This is an interesting trade right here. So what I've created is in August, buying the 33 calls, selling the 35 calls. This is if you want to be a little bit more aggressive. So you don't like the idea of selling puts because there's not a lot of premium in these puts. There seriously isn't. But this is an interesting trade because if you look at what I just constructed, I'm buying the August 33 calls, selling the August 35 calls for a 99-cent debit. And it is a debit. But the trade itself, all right, is in the money by 95 cents. So there's almost no extrinsic premium associated with this trade. It's a straight risk one to be able to make what? 2, all right, the 33.35 spread. So it's risk 1 to be able to make 2 in here. It's risk 1 to be able to make 1. I'm losing my mind as we go along over here. This is it's kind of an interesting trade that some of you might want to look at. So you're buying again the 33, selling the 35s, 2-point wide spread for a 99-cent debit here. It's literally, if you look at the trade, and I'll hit confirm and send, and I'll move this price to $1 right now. To give you an idea, it's risk $1 to make $1. There's about a 50-50 shot in here. But if you think about like TBT, as it oscillates over the next 52 days, and this trade is on for 52 days, for the most part, as it is oscillating, at some point, this trade looks like both a winner and a loser, okay? And it's just an interesting trade for you to be getting aggressively long something like TBT without having to go out and buy shares. And it's got a better probability than just going out and buying, for instance, the 35 calls there. So with that, let's kind of jump to another topic there, and hopefully I give you guys some insight to a kind of a trade there on TBT. And by the way, if you don't like trading TBT, you just get short TLT. Personally, I don't like getting short on days that indexes are down, but if you wanted to get short TLT, you could just sell, for example, the 96-98 spread on there. One other thing I talked about about a week or so ago on this particular show was an iron condor in SLV, which was a neutral trade. That iron condor was for July, and I've been talking about this over the last couple of weeks. The iron condor was put on, right around when SLV was at about 35, and the iron condor is still on right now for the month of July. I'm going to take a look at the chart here. Kind of zoom in. We've just had a really sideways kind of a chop trade here in silver after that monstrous sell-off. But what's interesting about silver is the volatility has maintained fairly high, which is a decent thing for you. Volatility was about 52% when I put this iron condor on. Now it's about 42%. One other thing I'm starting to look for also is an entry point in a trade here on Starbucks. So, again, kind of another trade idea, and I started thinking about this a few weeks ago, giving you guys a couple of trade ideas. So if you know me, I'm a huge contrarian, and I like the idea of getting short Starbucks. What insane person would want to step in the way of this freight train? I mean, you look at this uptrend here. I'm that insane person. I like the idea of getting short Starbucks. It is at its high right now. And if you want to go back and pull up charts for the last, for instance, for 10 years, it is pretty much at an all-time high right now. So keep that in mind as you were to look for instance, for a short trade here in Starbucks. Now, one thing I really wanted to note, getting short Starbucks does not mean shorting the stock. You got to be out of your mind to just go out there and short stock. All right, you got to look for a trade possibly out in August, selling a call spread and or buying a slightly in-the-money put spread. If you want to get, again, more aggressive, is buying an in-the-money spread. Don't pay too much for extrinsic or time premium associated with that. But you could go out here and you could sell, for instance, the 40-42 spread over there. Not a huge credit in selling this particular call spread here. The more aggressive trader might turn around and buy, for instance, a 39-37 put spread. So some different ideas for you guys if you're interested in getting short Starbucks. Again, I like to stand in the way of a freight train. So somebody's like, I have some Starbucks. Listen, I have Starbucks sitting in front of me. Obviously, I'm a well-caffeinated individual here, but at the same time, it makes me want to get short. Why? I mean, what have they done? What have they done? Open up a Starbucks in the bathroom of the Starbucks? By the way, that would probably help me out a little bit because Starbucks is a cyclical thing. With that, it's, listen, I'm not looking at the actual company. I'm just looking at the dynamic of the trade over here. And take a look at the chart, and Starbucks is pretty much at the all-time high. Again, a lot of people don't want to step in the way of that freight train. Me, I like it, and I'll start to build a position here over time to get short. Anytime I do this and I say, I want to get short Starbucks, and I put on like this little position and I wait to build a position over time, usually I put on that little position and the market just sells off, and I'm like, son of a, and I miss it. And that happens from time to time, but I'd rather do that than build one monstrous position all at one time. With that, kind of wrapping up here on the Options Hour, if you guys are listening next week, you got to give us a call next week as we do this show on July 5th. Futures haven't moved. They're up 13. NASDAQ futures up 28.75. My name is Don Kaufman. Thank you very much for joining us for this Options Hour. Join us again next Tuesday, 1 p.m. Eastern Standard Time for the Options Hour. On behalf of Thinkorswim, myself, everybody at TD Ameritrade, thank you guys very much for joining me today. Bye-bye.